Hey everyone, how you doing today? As mentioned in the daily financial news, I'm excited to test out something. Something I've seen on this One Rental at a Time channel is we have lots of people interested in real estate investing. We have lots of people taking the course, How to Get Started One Rental at a Time. And what I'm hearing from you is, hey, if you are the, kind of the perfect borrower, 800 credit score, money in the bank, it is ridiculously easy to go get cheap 30-year money. And if you're in California, you have given me great feedback about Matt the Mortgage Guy, which is one of our experts on Wednesday. But what I've heard from a lot of you is, that's cute, that's great, but it doesn't help me. Well, good news. We talked to John Burns Consulting a couple weeks ago about Investor Mania 2.0. And in that report, we had a lot of discussion about the NQM market, non-qualified mortgage market. And that is a huge and deep market. So ever since that discussion, I've been looking for a potential provider to help my students, help my followers. And I have one that I want to test out. So let's welcome Stephen Dow from Velocity Mortgage. How you doing, buddy?
I'm doing great, Mike.
Oh man, this
How
is
you
going to
doing?
be, I'm doing great. So we're going to test you out, right? You have provided some great information.
Bring it on.
I love the attitude. So we're going to get into it a little bit. We're going to talk about Velocity Mortgage, the programs you offer. I'm going to be very clear on the expectations that I am looking for from you to see if this continues on. I'm going to consider this a 4-week test. So first, before we get into it, we set those expectations. So let's give you a little chance to introduce yourself. Stephen, tell us a little bit about Velocity Mortgage.
Fantastic. Well, Velocity's nationwide direct wholesale lender, specializing in again non-QM, more of a asset-based loan, to where we're not requiring your normal personal income documentation, tax returns, pay stubs, W-2s. It's an alternate kind of underwriting kind of perspective, where we're looking at the income earning aspects of the property and comparing that with the mortgage payment, so that there's debt service ratio, things of that nature, versus personal income against personal debt, where you get DTI. So it's a different kind of underwriting, but still I believe very helpful in this type of market, because we're somewhere in between conventional bank financing and traditional hard money. So we fulfill a pretty good space, a nice little niche.
No, the NQM market is deep. It's big. It is a market that frankly didn't exist when I was doing this big time, at least not in any meaningful way. It's one of those things that was spawned out of the last crash, right? There's two things that I think happened after the last crash. First, Wall Street or hedge funds or whoever you want to blame proved that you could buy a lot of single family homes and make it a business. The second is, man, Wall Street is smart. They figured out that there's a gap between 12% hard money and 3% bank money. There's a lot of margin in there. And that's where Velocity Mortgage plays. You can get very creative when it's your own money, because you're publicly traded. When it is your own money, Velocity Mortgage can create programs to fit basic needs. And we're going to talk about 3 or 4 of them today, folks. So they're coming. But again, this is why I wanted to get a non-QM vendor on the One Rental at a Time channel. Because there's just a big gap between 3% 30-year and 12% short-term hard money. And I know there's a provider there. I'm trying to find one for you. We're going to give Velocity a shot. So let me bring up the presentation I have first, because again, your team was nice enough to send me something, but of course I wanted to create my own, because that's just who I am. Let's make this bigger. And you know what? I'm going to hide us because it takes up some real estate. So again, folks, I'm going to go through this. Let me just start at the beginning. So again, I believe there's a big challenge for accessing loans. A lot of you are doing BRRRR projects. A lot of you are investing in the Midwest, and maybe you don't have relationships with credit unions or banks. And the NQM market is huge. It's actually deeper than I thought. I did research after that John Burns call, Investor Mania 2.0. It's pretty deep. We do have, again, I'm going to give credit out to Matt the Mortgage Guy. You guys have tested him out. He is serving your needs, rave reviews. But he's only licensed in California, and he's really getting you bank money. So if you're kind of that clean first-time buyer, clean refi, he is great to work with, but it doesn't solve, frankly, it doesn't solve most of your needs. That's why I'm bringing on a non-QM lender. And again, I want to test them out. We're going to do this for 4 weeks. We're going to talk every Friday at 8 a.m.
Let's do it.
And we're going to see what they have to bring. So again, Stephen, Velocity Mortgage, this is just a taste of what's to come. Right? You do investors 1 through 4, mixed use, multifamily, commercial. You kind of play across the board, right?
Oh, definitely. Very user-friendly product for the fact that, if you fall out of conventional financing, you're typically forced to use hard money. So
Hmm.
that's when you can rely on us to, again, get financing not only on 1 to 4 units as you stated. So
Hmm.
that's where when I came across your program and I purchased it and
Yeah.
I started reading in your course, I saw
Yeah.
a perfect kind of a segue because again, that's the market that we serve.
Yeah.
So, but yeah, you can use it for both 1 to 4 unit non-owner residential, commercial, as far as multifamilies. So, just
Hmm.
wanted to tailor specifically to your audience, excuse me, but
Yeah.
multifamily for all the way up to 5 million,
Yeah.
all the way down to 100,000. So, pretty big range.
Yeah, it's a huge range. And again, I think it fills a need. We're going to test it out. And again, I failed to mention early in the introduction is this really started because Stephen is a member of my course. He understands the vocabulary we talk about. He's in the Facebook group. So that's what, we're going to give this relationship a shot and see how he serves your need. Again, your nationwide direct portfolio lender. What does that mean, direct portfolio lender for a layman? Stephen?
Well, basically, there's no middleman. We're not, having to utilize a board of trustees, as far as utilizing someone else's money, as far
Mhm.
as hedge funds and things of that nature. So everything from the setup person all the way up to the CEO are
Mhm.
all under the same roof. So you get the answer directly from us. It's our money. We fund the loan
Yeah,
and everything else. So it definitely works out
that was
much
important.
easier.
Yeah, that was important for me to bring to the table. I wanted somebody who was making the decisions with their own money, because when
Right.
that happens, you not only get quicker decisions, but you also get more creative, right? If you're some kind of
Oh,
portfolio of portfolios, you got to go
definitely.
through 7 layers of decisions to get anything done. You're gonna
Right.
get yes or no answers faster this way. And again, I'm not here
Oh,
telling you all of you are going to get yes answers. Some of you are going to be disappointed, but he's going to tell you
right.
why. And
Right.
it's their, and again, it's their money. So that's what excites me about this relationship.
Well,
So
we can
again,
expand upon that in the
yeah.
next couple of weeks of this particular series. But long story short, with compensating factors,
Mhm.
good credit scores and things of that nature, good reserves after down payment will kind of typically allow us to offset some of the deficiencies of your profile
Mhm.
or even your deal. So I would call this a make sense type of lender. So there's a
Ah,
lot
I
of,
like that.
yeah, we could definitely work with a lot of different people. Maybe on the surface, you may think that you're not qualified, but with compensating factors, we could work it out. So along again in the next couple of weeks,
Yeah.
I'll be able to kind of help people fish, not only just giving them fish.
Yeah. Well, yeah, we're going to give a lot of examples. We have a plan for the next 4 weeks, but the whole idea, folks, is you get excited by this. And as you'll see at the end, I will give you his email. I want you to test him out. I want to check you customer service. Again, I'm not here sitting here telling you you're all going to get yes answers. That's not what I'm doing. You're just going to have another option. And I thought I took this slide, obviously, from your marketing deck. This is just where you
Right.
play, right? Different rates, different
Correct.
terms, different programs. And what I really like about this is it's your money, faster yes, no answers, but it's
Yep.
about the deal, not the borrower as much. And a
Correct.
lot of people think they have a great deal, but the banks tell them no for whatever reason, stated income, DTI, whatever. You're going to look at the deal, right? And you guys have experience in doing that. So I
It's
think
kind
this,
of a combination. Again, based upon how we look at the overall deal, we typically would prefer, higher quality credit profile for the borrower. But again, we're more lenient in the way of income qualifying.
Mhm.
So really good fit for self-employed borrowers, small business owners, things of that nature. That typically have some challenges as it pertains to their,
Yeah,
taxes and things of that nature. So
that's that,
definitely a good fit.
that's an important piece to bring up because traditional bank lenders have essentially shut off that part of the market, right? With the
Well, it typically forces them to have to, use hard money because of the
yeah.
way traditional conventional underwriting is done. As it pertains to self-employed people or
Mhm.
borrowers, they're usually using just the net adjusted income versus the gross. So a lot of times that's just a much smaller number. So yeah, it makes it a lot more difficult to qualify for conventional bank financing.
Cool. So again, why don't we talk about this fix and flipper? I actually added the BRRRR on this slide, so I took your
Okay.
company's marketing deck and I took a couple of samples. This one, and I think one other. But you want to talk about this this program here?
Sure. As far as because I apologize, I don't have.
Oh, it's just says, that's fine. Fix and flipper. I forgot you're looking at this on your phone. It just talks about single family home purchase, fix and flip.
Got it.
You can't show consistent income, but you want to recoup your capital. You know, the whole idea is buy
Perfect.
cheap and, you know, get the money out later.
You're going to love this. So we provide a particular program called our ARV Pro. Basically, you know, in the case of specific to your market, where first time, you know, somewhat inexperienced flippers, which we welcome them to a certain extent. We would like, you know, higher credit profile, you know, good reserves, things of that nature. So again, later on in the next couple of weeks, we'll go over how to prepare yourself to be, you know, in the best light when trying to apply for these types of loans. So we can kind of build you up to that point to where you should be able to get, you know, as far as the qualifying from the income and the borrower standpoint. And then we'll look at the actual, you know, schedule improvements, things of that nature, and then look at the ARV, future value, and kind of see if the project itself is doable. So other than that, with our ARV program, we finance 75% of the purchase price, 100% of the rehab, to a maximum of 75% of the ARV. Right, of the not to exceed the 75% of the ARV. So in comparison with you know, other private money, they'll typically cover 100% of the acquisition, but you got to bring in the rehab. So in many cases, that's not as advantageous to your borrowers because they got to, you know, come to the table with more money for the rehab versus putting down just a smaller amount as far as down payment in comparison, because typically your purchase price is going to be somewhat of a discounted, you know, so that the down payment off of the 20 or 25% off of that discounted price is going to be a lot less than say the 40, 50, 60,000 of rehab funds. Exactly.
And again, folks, what you're going to see here is Velocity Mortgage. And when you test Steven out, there's a lot of programs to go through. I didn't want to inundate you with all of that in this intro video. We will cover those in the next 3 or 4 weeks. And again, there's a couple more slides coming that will give you a taste of that. The other one I just added here is small business owners. And again, this is because I'm hearing from Matt, the mortgage guy, that's a market he really can't serve today because of what happened with their tax statements, right? They have an income gap. They were shut down for 4 months because of this or that state governor. And
well, again,
go ahead.
I mean, our product is kind of tailor-made, especially for, you know, somewhat current events over the last 12, 18 months. Not many people can show a lot of income, you know, especially landlords or people who are self-employed. So it makes them even much more difficult to qualify for conventional financing. So that's where we can come in and kind of provide a much more cost-effective alternative to, say, your traditional hard money.
Yeah, and again, folks, what's happening here in this first introduction is I'm hoping to give you a taste. I will give you his email at the end. I want you to reach out to him and test him because he knows this product a lot more than me. I'm never going to learn him. I'm just trying to be a conduit for you. So let's keep going. So again, I'm bringing up the mortgage program slide. So we talked about ARV Pro already, which is in the bottom right, folks. But you also have Flex to Perm. You want to talk about that?
Sure. And again, tailor-made specifically for your students in your audience, I believe, because again, with the buy and hold structure, initially with the ARV program, that's a 12-month interest-only loan. So allows you some flexibility there to, you know, get the financing you need for the rehab. You have 30 days to start the rehab, 6 months to finish, but there's a little bit of wiggle room as far as an additional 6 months, just in case of market changes or delays in rehab. It makes it a lot easier versus traditional hard money, which typically gives you maybe 6 months for kind of rehab. Then with the Flex Perm loan, we can take it out of that ARV and roll it into long-term, which is our 30-year fixed loan.
Wow.
So yes. So now non-QM 30-year fixed, 30-year amortized. So now you can kind of do the model of the buy and hold. So to allow your students, your audience to, you know, acquire, look at the project, get the rehab. After rehab, you can then use the new higher appraised value, even though you've owned it less than 12 months, which many lenders require you to have that type of seasoning or ownership of the property to be able to use the new higher appraised value. So that's kind of an advantage with our product. So say you're seasoned a flipper, you can get the rehab done in 3 months. Well, in 3 months, now we can use the current market value at up to 75% of that to then typically pull out a lot of not only your down payment, but even some of the rehab funds to then maybe apply to the next project. So
let me try to summarize what I think I heard you say. in my
Yes.
words, right? So again, I know a lot of flippers across the country that are really good at what they do, and they create a lot of what I'll call sweat equity. In
Okay.
the conventional market, they're kind of trapped because
Right.
at best you have to go for 6 months in a day, and some of them are 12 months before you
Right.
can wring out your equity and
Right.
keep the assembly line going, right? So
Right.
what you're saying is, hey, come to me. We'll line you up with an ARV Pro, right?
Yep.
25% down of purchase. We'll fund the repairs, probably on a draw or whatever.
Correct.
Then you go do your thing. You're doing the one rental at a time. So let's just say at month 5, you stick a renter in it,
Yep.
and now it's dialed in. You've got proof of statement. You got a lease. You could come back and convert that to a flex perm, which gives
Correct.
you 30-year fixed,
30-year
30-year
fixed,
amortized.
30 amortized. Yes, sir.
Oh, wow. All right.
Yes.
All right. I
So
like that. I like
again,
that.
after pitching your course, because again, I really believed in your message and everything else, I found it just so serendipitous in a certain sense that it just kind of fit exactly what we've been doing
Yeah.
for a while now. So allows again to acquire the property, rehab it, use
Right.
the new higher appraised value,
Yep.
Less than 6 months, pull the equity out, apply it to the next project, so you stay more liquid and you
Yeah.
have the ability to kind of work on multiple projects.
That's pretty crazy. All right. Well, there's 2 more on here. Again, these are your slides, so I don't know the program. There's the Fast 50.
Right. Well, Fast 50 is a program that's kind of tailor-made for, I would say, kind of 2 ends of the spectrum for
Okay.
certain types of borrowers.
Okay.
So you have your, good borrower, good credit, but only needs up to maybe a 50% LTV as far as loan to value against the property. You're going to get better rates, or
Of
the
course.
best rates as far as long term. So the Fast 50 is basically the little brother to the Flex Perm loan, where it's our 30-year fixed, 30-year amortized loan program. So, but again, if you only need 50% LTV, your rates are going to be typically about half to about 0.75% lower than the Flex Perm loan.
That makes sense. Because again,
Yeah.
that's important, right? Because again, a lot of my people in my course, some of them are closer to the end than the beginning, and they want to
Right.
be very conservative, right? I know I have several loans at 50% of ARV. And again, if you're a good borrower and you want to go that, I assume that's a relatively fast, quick yes answer.
Oh yeah, no, definitely. We want that type of product because again,
Yeah.
we want to attract those types of borrowers. The leverage position is so conservative and typically higher quality borrower. It just makes sense to try to
Yeah.
attract those types of people. So
Yeah,
it's a
and
win-win for
again,
everybody.
this is pretty awesome because banks don't think this way. Banks
No.
don't go, let me go after the type A borrowers, 50% LTV, and then give them a faster yes and lower rates. They just don't think like, they're not built like that. They're right. I only want first time buyers, 30-year fixed. It's crazy. Well, there's one more on here. I want to talk about the Flex IO.
Yes. So that's mainly for short-term bridge financing.
Okay.
It's a 24-month interest-only loan. So something to where you're not looking to buy and hold, but just need a slight bridge in between.
Yeah, it's kind of a big value add, maybe.
Well, yeah, to some extent. I mean, it just depends on your circumstances. Maybe you just haven't filed your taxes yet, So in the next 2 years or so, once you do, you can qualify for conventional financing. So that's a nice little kind of bridge loan until you get to that point.
Yeah.
So yeah, much more cost effective than your traditional hard money as well in comparison. So
Yeah.
we'll go over those in more detail later if you like.
Yeah, absolutely. So again, these are just samples of what's coming. Again, what I'm hoping my audience is getting excited. They're seeing what's possible here. They maybe have felt frozen out of record low interest rates. Again, NQM providers are that kind of middle ground that I didn't have when I was building my journey. So hopefully you're getting excited. Steven's email's coming up, so get ready for that. But there's even more programs I'm sure available. I just got these 4 because again, you're about being flexible. You're about filling what the market needs. So I appreciate that.
Yeah, to some extent. I mean, I don't think we're going to be everything to everybody.
Yeah, of
we
course.
service a specific market,
like
and
that.
in actuality, these are all of our programs. So,
cool.
we don't do everything for everybody, but what we do very, very well. So
I like that. Okay.
I believe your audience and your students are going to be very pleasantly surprised.
I look forward to that. So again, so I wanted to do a couple of things. I'm always about being honest or really upfront with my teams and declare there's a couple of markets you don't play in, right? So I got this from you this morning, right? So I'll just read this for the audience because I don't think you can see this. It says states we do not lend it at all, 1 to 4 units is North Dakota, South Dakota,
right,
Minnesota,
correct,
Vermont, some restrictions in Chicago, Illinois, no Detroit or Flint, Michigan, There are
Right.
other cities like Baltimore, Maryland, New Haven, Connecticut, South Miami, Miami, Florida, that have certain restrictions apply, maybe
Correct.
capped at 50% LTV.
Right.
Yep. Again, it's okay. I mean, again, folks, the whole idea here is they're investing their own money. They get to make the rules just like a bank, right? They have yes and no answers. So
Correct.
this is
Well,
a short list.
I'm sorry. I mean, yeah, I didn't mean to cut you off. I was going to say,
It's
even
okay.
with some of those limitations and restrictions on just a short number of states or areas, but we pretty much cover about 44 to about 46 out of the 50 states.
Mhm.
So it's a
Yeah, it's fine.
huge market that we can service. So
Yeah.
yeah.
Again, it's your money, your rules. There's no judgment. I'm not asking why. It's your list, man. It's totally fine with me.
Well, it's easy concept. We want to be in the more densely populated areas, just
Mhm.
because that's where most of the action's at. So yeah, that's why we stay out of more rural type areas. But
Yep.
we can go into more details with
Yeah,
that stuff later.
I'll let the audience do that.
Yeah,
It's not for me to
perfect.
care about. So again,
No, that would be way
yeah.
longer show for sure.
Yeah. So another one, again, these are just things just to tell folks. States we do not lend in for commercial multifamily properties: North Dakota, South Dakota, Minnesota, Vermont, Illinois, and Michigan.
Correct.
Just being very clear. And then lastly, I get a lot of questions about 50K loans. So you were nice enough to give me some examples. Folks, again, I'm going to read this because Stephen can't see this. Yes, we can do loans on properties valued at under 50K or at least 50K or more, either with blanketing 2 or more properties. So folks, the good news here is don't go get one 37K house, go get 2 or 3 37K houses. That's what he's telling you, is go bigger. We can
Right.
either blanketing 2 or more properties purchased under one loan with the Flex Perm, Flex IO, or Fast 50. Again, call him about those programs. Correct. So the combined loan amount reached our minimum loan requirement of 75K. Again, folks, it's their money, it's their rules. We don't get to judge. So this is all good. Again, these are just, yeah. So again, do the examples, do the work. And again, folks, the reason why nobody loans under 50K is because of Dodd-Frank. It makes it, frankly, not profitable. That's frankly the quick answer. So again, folks, these are my expectations. Let me close this picture a little bit. So my expectations, I want the ORAT, one rental at a time. That's what that is, ORAT family. I want them to reach out to Stephen for discussions. I want you guys to test him. I want you to start sending him emails today to see if he can fill the need. He is going to ask you, he's going to have a quick conversation, a quick email with you. You will likely have to fill out 2 forms. One is you're going to have to tell him about the deal, and one you're going to have to tell him about you. There are quick forms. You will get them from Stephen after a quick discussion, but realize these are not phone call yes answers. They will need to look at the deal and know a little bit about you. So here's the deal. Here's Stephen's email. It is sdao@velocitymortgage.com. I will leave this up here. You can take a screenshot of it, whatever you like. Again, as I say, let's test him out. My hope is he gets emails today. My hope is
bury me in emails. I don't mind. I'm ready.
Emails over the weekend. Again, you will likely get back, okay, great. I think we can do something. Maybe it's this program, maybe it's that, but he's going to send you 2 documents. One is about the deal and one is about you. It is on you to reply and be as complete as possible. I am not involved in any of this. I'm just trying to fill a need. So again, his email is sdao@velocitymortgage.com. And that's all I got, man. Any kind of closing thoughts?
Yes, actually, to kind of roll this off on a good note, since it's the 30th day of April, I'd like to offer a special for your first 30 applicants or calls, free appraisal.
Wow.
On our ARV program or any of our other programs, depending upon if you're looking for commercial financing. So that could be anywhere from an $800 to $2,000 savings. So
wow, free appraisal for the first 30. Well, if that didn't get you excited, folks, I'm gonna get this posted hopefully by noon. So my hope is, honestly, I hope you text me close of business this evening that, hey, I got 5, 6, 7 emails. So again, Yeah, it's again, wow, that's really nice of you. The first 30 get free appraisals. So
Yes, sir.
Stephen, this is fun. We will talk again next week. I hope the audience, the ORET family, floods you with requests. So we'll see what happens, huh?
I look forward to it. Thank you again for the opportunity to service your students and your audience, and looking forward to the next couple of weeks. So thanks again. Have a great day.
Take care, buddy.
You too, bud.